All right, folks, welcome to Leading Indicator, a show by Public.com, bringing you the insights from the world's best macro minds. I'm your host today, JD Durkin. We are with you today to discuss the current inflation dilemma, and is it ever one? We'll also talk liquidity levels, plus their impact, and so much more. As always, don't forget to like, comment, and subscribe to our YouTube channel for more in-depth interviews that will help keep your latest portfolio on track and keep you up to date with the latest investment news. Today, we are joined by Daniel Lacalle, Chief Economist at Tressis. Daniel, thank you for being here.
Thank you so much, JD. Thanks for inviting me.
Of course, so there's no shortage of macroeconomic news that we could talk about from the month of June, and the month isn't even over yet. Of course, recently we had the Fed's decision to skip a rate hike after CPI inflation showed 4% annual growth for the month of May. Daniel, give me your take. Why do you think the Fed decided to skip this particular round of short-term interest rate hikes, even as inflation still remains, as we all know, pretty far above the 2% target?
Well, I think that the Federal Reserve is caught between a rock and a hard place. On the one hand, it knows that PCE deflator, that core inflation remains significantly more elevated than one would imagine, particularly after the slump in commodities. We have to remember that most commodities in international markets are trading well below the pre-Ukraine invasion levels. So I think that the Fed, on the one hand, knows that rate hikes and monetary contraction need to continue, and that's why they gave the message of at least one, if not two, more rate hikes in the future. But at the same time, they're extremely aware of the fragility of the banking sector, and they know that they had to step in very, very quickly and inject billions of liquidity in order to avoid a much more dangerous contagion of the regional bank situation. So it's basically trying to cope with their ideal scenario, which is the so-called soft landing, and at the same time trying to avoid a liquidity crunch that could create a financial crisis.
Danielle, are you in the camp of people who today say, despite what we thought a few months ago, suddenly the possibility of a soft landing seems much more in play than it did even a few news cycles ago?
No, I think that the idea of a soft landing is interesting intellectually, but it's impossible. Either we have a significant slump in the economic activity of the private sector, because we have to remember that the public sector is not reducing its imbalances, or it's virtually impossible to get a soft landing. The idea of a soft landing with a significant reduction in inflationary pressures is in itself, think about it, it's virtually impossible to think of an environment in which aggregate demand, public and private sector demand, remain relatively stable, even growing, and at the same time see prices be falling and falling to levels that are consistent with a 2% inflation. And monetary aggregates don't gel with that situation. So I think that the Fed has to talk about a soft landing because they cannot talk about a recession. But it's obvious in consumer confidence, it's obvious in both consumer trends and investment trends that the impact of rate hikes is still to come in the economy, and we'll have to see whether that plays out relatively smoothly. But I find it very difficult to curb inflation and at the same time maintain a 2% level of GDP growth.
Daniel, in your estimation, what are the main contributing factors for inflation being where it is now at about 4%, or as we know, last summer getting as high as 9.1%? What exactly happened?
Well, to start with, in 2020, we suffered the most dangerous monetary experiment in history. Now, in 2020, in 3 months, central banks injected more liquidity, i.e., printed more money, than in all the period of what we called monetary expansion that we saw before. The European Central Bank added to its balance sheet 5 times more than what we called the famous Draghi bazooka. No, so the monetary expansion that was directly financing government spending created a huge artificial demand that is basically fueling inflation all over the economy. Inflation at the end of the day is not prices rising. Inflation is the loss of purchasing power of the currency, no? And what we have seen is that the is that where money goes, we have higher levels of inflation, i.e., more units of currency go into relatively scarce assets. At the beginning, we blamed commodity inflation on the situation of developed economies. However, commodity inflation is a monetary phenomenon. More units of currency go into relatively scarce assets. And it's interesting because the moment that the Fed, the ECB, the Bank of Japan, the Bank of England started to hike rates and reduce money supply, commodities, despite the fact that the Ukraine war was ongoing, that China was reopening, that India was growing at much faster levels than anybody would expect, despite all those elements and supply cuts from producers, commodities slumped to below pre-Ukraine levels, pre-Ukraine invasion levels. No? So it shows that rate hikes and monetary contraction worked better on reducing inflation, headline inflation, and that the previous massive increase in inflationary pressures was due to the increase in money supply. There's a fantastic paper by Claudio Borio at the Bank of International Settlements showing how the massive inflationary burst in developed economies was preceded by a massive increase in money supply well above previous occasions. And I think that is also an important factor.
You've also talked about the role of protectionist policies as sort of a central component of this entire conversation. Daniel, for people who might be unfamiliar listening to this interview right now, talk to me about what you mean by protectionist policies and what role have they had in everything we're discussing right now.
Yes, in an environment of inflationary pressures, usually competition and trade tend to smooth out the inflationary pressures in countries. Inevitably, there will be new members of the trade community that will find opportunities to sell their products at a better price than what is being sold at one given moment. No, however, when we see that governments start to implement protectionist measures, disguising them, for example, as they do in the European Union under the environmental umbrella. No, you basically are limiting the ability to trade and to import goods and services from other countries, or literally just putting trade barriers, as we have seen between China and the United States, etc. All of that limits the positive disinflationary effect of trade. Ultimately, if we think of inflation, as I said before, as a monetary phenomenon, trade basically reduces the impact of that monetary phenomenon by bringing more goods and services produced in countries with stronger trade opportunities. No? And that level of protectionism that has been stealthily rising in the past 7 to 15 years is certainly putting a limit to the positive disinflationary effects of higher trade and competition. When governments limit competition or put barriers or put tax breaks on the chain of supply, that is also a very significant element. Think about this. When people talk of supply chain disruptions, no, as an inflationary cause, supply chain disruptions are nothing but government-imposed limits to trade. It's not we have gone from a period in 2016 to 2019 where there was not just ample supply, but excess supply of freights, of copper, of aluminum, of storage, and suddenly freight charges went through the roof. That is not because there was lack of freights available. That was because of limitations to trade, because of different impositions from governments. No? So ultimately, governments tend to make inflation more persistent, and it's very simple. Governments consume between 40 to 60% of the GDP of developed economies, and on the one hand, they have the ability to restrict, limit, or impose barriers to trade, and on the other hand, they are the first recipients of newly created money. So at the same time, they implement stimulus packages that are financed with newly created money. That makes inflation more persistent.
To this point about inflation, Daniel, it still remains elevated. We know the figures from CPI suggest 4% annual growth for last month, 4.4% if you take in PCE data for the month of April. What are your expectations for inflation going forward? And what do you think that impact will be on interest rates? We know Chairman Powell had to say, we're likely looking at 2 more interest rate hikes between now and the end of the year, but certainly market participants are inclined to maybe not exactly be on the same page as the chairman of the Federal Reserve, a continuation of something we've seen for quite some time. So where do you think inflation might be going from here?
I think that in the next months, we're going to continue to see inflation coming down quite rapidly. Monetary aggregates show it. There's a massive contraction in money supply, and that obviously does bring down inflationary pressures very, very significantly. But that reduction is not enough to at least offset what has been a very dramatic impact of loss of purchasing power of currencies in the past years. Ultimately, inflation is accumulative. So inflation might be down to 3 or to 3.5%, but it's accumulated over a previous 7, 8, 9%. So the accumulated inflation that citizens are suffering is about 20% in the past 4 years, which is enormous. So inflation is certainly going to come down. We see almost in every part of the economy, from the credit part to the commodity part, that the monetary contraction and the rate hikes are certainly working to reduce that inflation. However, the big problem, you've mentioned it before, is core inflation. Is that core inflation remains extremely elevated. And that is fundamentally because if you really want to reduce inflation, you need to do 3 things, and those at the same time. You need to hike rates, that is happening. You need to reduce the amount of money supply, that is already happening as well. But you also need to reduce government spending, because government spending was where all of that excess money creation went in 2020, 2021. And governments are not reducing expenditure. They're actually, in many cases, even increasing it. No? So that may perpetuate core inflation. There's another thing, is that the base effect works now in favor of inflation reduction. If you come from a 9%, it's easy to see that the next inflation print is maybe 3%. The problem is when you go to a base effect that doesn't work in our favor. And that is what we need to monitor. And that's why I think that the Federal Reserve gave that sort of strange message. On the one hand, say we're not going to increase rates now, but we're going to increase them a couple of months later. What are they thinking of? They're probably thinking that the base effect right now is much larger on the reduction in inflation, in headline inflation, than the impact of monetary contraction. So probably what they're thinking is, let's see what happens when the base effect, instead of working in our favor, works against us. Are we going to see an inflationary burst? I don't know. So I think that that's what they're doing. They're basically playing around because they cannot work with monetary aggregates while at the same time injecting massive levels of liquidity to
Sure.
help.
So let me pop in if you don't mind. Let's go there with the conversation back to liquidity injections. Do you see this as a strategy by the Fed causing a bit of a return to quantitative easing? I mean, talk to me through the lens of investors who've expressed understandable worries and a lot of concerns over these very liquidity injections, specifically for banks after the banking crisis we had a few months ago.
Well, liquidity injections on banks are not quantitative easing, but they have a similar effect on markets. On the one hand, it is true that liquidity injections are going directly to fill a financial gap in the bank. So it's not purchasing government bonds, and it's certainly not creating the multiplier effect that quantitative easing creates in markets with massive multiple expansion, huge sector rallies, etc. However, liquidity injections have worked in terms of bringing markets from a contraction period to a recovery. If you think about it, the moment that the Federal Reserve and the Central Bank of Europe stepped in to stop the liquidity problem of banks, immediately markets started to react. And the entire recovery of markets up until now has been multiple expansion, has been an improvement in valuation. So it has worked similarly to quantitative easing, although it is not quantitative easing, and investors should not think about it from the perspective of, okay, this is the opportunity to buy anything and everything. Actually, as we have seen in the recovery of the S&P 500, it was basically led by 4 stocks, no?
Yeah, of course. How is the impact? What is the impact on the Fed's balance sheet then?
Well, the balance sheet of the Federal Reserve was coming down quite rapidly, actually faster than what many of us expected. And it reversed entirely. And we have seen a period in the last 3-4 months in which the almost 60% of the normalization of the balance sheet was unwound by the liquidity injections to sort of disguise the banking problem.
Could the monetary policy cause a continued upside for inflation in terms of the conversation we were just having with regards to the separation from traditional QE, but also the impact on the Fed's balance sheet? What does this mean for the overall inflation conversation, if anything?
It can probably make it more persistent. It can certainly, think about this. If the normalization of policy had been the way it was announced at the beginning of 2022, today inflation would not be at 3-4% in the developed economies. It would be at 1.5-2%, because there's been, I come back to the point, there's been not an entire U-turn, complete change in trend in commodities that has not translated to better, to the extent that it should have in overall inflation. So I think that there are sticky elements of inflation that are dangerous, certainly. And in core inflation, I think it's pretty evident. That's why central banks are not taking a dovish approach. They're basically saying, look, we're looking at core inflation. Core inflation should be plummeting, not coming down 0.1% in month on month, which means nothing. It should be plummeting.
Final question for you, if I can here, Daniel. Can we put the totality of the recent banking failure, you think, firmly in the rear view? And if we do have more banks collapse, what would the impact be on inflation, you think?
Well, can we put it in the rearview mirror? No, because the entire solution to the banking crisis was to disguise the asset problem that these banks continue to have today. No? So it's sort of a band-aid solution, but it's not a permanent solution, and certainly does not reduce the challenge that banks have after years of negative real rates and after years of investing in bonds that have very limited value now, no? Because they were investing in bonds that had virtually no real yield, no? I think that that is very, very difficult to solve in one go. But I think that the impact on inflation is significantly more evident when we see, for example, that despite the massive banking crisis that we have seen in the United States, credit supply has not fallen. And that, if credit offering, credit supply is not falling, it means that the level of persistence of inflationary pressures are likely to be more prolonged than what we would have expected, considering the monetary aggregates and considering the change in the trend of commodities.
All right, my special thanks there to Daniel Lacalle, Chief Economist at Tressis. Daniel, thank you so much. A great conversation with much needed context during an important moment of the year. Daniel, thanks.
Thank you very much. It's been a pleasure.